one of the big things that we do want to make sure everybody has an opportunity to do is to see the types of slides and the information that we look at to help provide us with some perspective. So I'm going to be sharing my screen now, so everybody should start to see a presentation pop up. And the first thing that we want to talk about is just how to think about the important terminology, so that when as we go through the next 15 to 20 minutes, we start to actually be able to share the same terms. So first of all, a market correction, a lot of these are terms that we're hearing on the news, is when the stock market is down 10% or more from its recent highs. So this is something that can happen while the market still has positive returns for the year. It was something that we hit earlier, but at that point, then we eventually entered what's called a bear market. And so that's when the stock market is down 20% from its recent high. So at one point in mid-February, the market was up about 7 or 8%, maybe a little bit more than that before it started its downslide. I think it was actually a little more than that. And that's, so where we're at now is not measured 20% from zero. It's measured from where it was at the high. A key separate piece of that is an economic recession. So frequently a bear market and a recession are put together in the same, but they really mean two different things. In the past, an economic recession has been 2 consecutive quarters with negative GDP growth. That would basically mean we would only know 6 months or more in the future if we had been in a recession in the past. Because of that, they've recently updated the definition so to reflect that a recession is a significant decline in the economic activity that will be lasting for more than a few months and will affect GDP, employment, production, and sales. So it's an important differentiator because there have been times in the past where we've been in a recession that wasn't a bear market and vice versa. The other two components are fiscal stimulus and monetary stimulus. Those are the things that either in the case of fiscal stimulus that the government is trying to do to help support the economy, or monetary stimulus that the Federal Reserve is trying to do to help the economy. Now it's important to put these terms in context because although all of those are very scary, there are frequently declines that take place. So on average, we can see a 5% market decline takes place about 3 times a year. 10% or more, which is that market correction, takes place about once per year. And then a bear market, 20% or more, takes place about once every 6 years. As you can see, the last occurrence for the 10% or more was in December of 2018. Some would say we did not quite get into a bear market in 2018. Before that, it had really been 2008, 2009. But as you can see on the bottom, it's important to note that this has been our 7th market correction since the start of the Great Recession in 2008, in 2009. Market drops do happen quite frequently. Whenever we're in the moment of one, it's very difficult to remember the last time that one of those happened, frequently because the thing that causes them is different. However, what you can see is on average, over the last 50 years, dating from 1970, on average, the market has dropped at least at some point during the year by 15.7%. So this is where we were at about a week or so ago before the additional changes took place. But again, it provides an interesting and important perspective that at some point during pretty much every year, the market was in the red at some point or another. A key component to be thinking about this is the total investments for most investors aren't just stocks. The other component is also the bonds. And this statistic here shows that bonds provide a lot of protection in the downside. We don't have a statistic or slides for the current market, but you can see even the most recent sell-off in 2018 when the S&P 500 was down almost 20%, bonds were up 1.5%. Our experience in our portfolios is that most bond investments have been up between 1% and 3% over the last few weeks. A lot of that has been because of that change. So that's an important component of providing some protection for a diversified investor. We also want to provide long-term perspective on performance. So this is a market quilt chart, which shows performance by year. The easiest one to track is to take a look at the orange one, which represents US small caps. And you can see year by year how small caps jumps around on that chart. Sometimes it's at the top, sometimes in the middle, sometimes at the bottom. The white block in the middle that's connected by the lines reflects a diversified portfolio of 60% in stocks and 40% in bonds. And one of the key components that you can see of that diversified portfolio is that it's really able to walk that middle line, being able to pretty much stay in the middle by having diversification to everything. Another key component is that for as difficult as it is right now, you can see in both 2018 as well as back in 2008 and even in 2015, there were other time periods where most of the stocks were in negative territory. 2018 was an interesting year where cash was actually the best performing investment at just 1.8% after being on the bottom. So an important component of a diversified portfolio is by having exposure to a wide variety of investments, it provides that opportunity to walk that middle line. We also take a look at whenever we see bear markets and bull markets, which in this case, the bull markets are reflected in blue, the bear markets are reflected in red. Unfortunately, bear markets and recessions are part of the general economic cycle that we are in. They happen on a periodic basis. One of the things to understand and that we really emphasize to our clients and others when we have conversations is, those bear markets on average last about 14 months. So a key component there is to have a cash flow plan in place for those who are in retirement, nearing retirement, or just need to rely on some cash flows from their portfolio. Because we can have the next 2 years or more of cash in place, then that provides that opportunity for the market to go down and come back up without needing to sell any of those equity investments. It's also important to put that comparison for the length of the bull market in contrast to that bear market from an average standpoint. Also, in all of these situations, regardless of how difficult they are at the moment, the market does recover. So these statistics are showing a portfolio that's 60% in stocks and 40% in bonds. And you can see in basically all of these situations, after 3 years, for 1 year, most of them are positive. After 3 years, they're all positive. And after 5 years, they're significantly positive. This is a reminder of the importance to stay invested. So 2008, 2009, which is the second one from the right, was notable because that was one of the slower market recoveries and economic recoveries, similar to 2000. Frequently, what we've seen is more like 2011, where that first year maybe is a slow rebound, and then it starts to pick up from there. It's a really important part of staying invested. That's difficult, however, because we are human beings and we all get emotional. And this is a really difficult time because really the comparison that I've made is that right now with the coronavirus feels like a combination of both 9/11 as well as the market recession in 2008, 2009. The components about 9/11 is because there is a physical threat to our well-being. In this case, it's from a virus instead of from terrorists, which creates a lot of additional emotional anxiety. And in 2008, 2009, because we're seeing the markets plummet and a lot of things are happening that just aren't very clear about why they're happening. And so with all those things going on, we need to understand where we are on this emotional curve, because our emotions generally work against us. If we follow elation, that's when we're going to want to buy stocks. And if we follow fear, that's when we're going to want to sell investments. However, that would basically mean buying high and selling low. And what we would prefer to do is to buy low and sell high. So a big part of our job is to have these types of conversations in periods where people are feeling nervous or feeling fearful, both of which are very rational, so we can try to find that balance to find optimism and see where that upside is going to be coming. That being said, the pain in the markets right now is extremely real. You can see the highlight in yellow, that's yesterday. That's the second worst day that the market has had. And if you go down just a few more bars, you can see from March 12th, last week on Thursday, when the market was down 10%. This bear market has been the fastest in history. On average, it usually takes about 40 days to go from a market high to a bear market. Actually, that had been the previous fastest. In this one, it took 17 days. So less than half the time to go from a market high to a bear market. So we truly understand that this is very painful. It's difficult to see your financial investments decrease this fast, plus with all the headlines that are out there at the same time. This is actually historically painful. So this chart, we were not the ones in charge of that exhibit saying that it's time to buy right now. But what you can see here is that we're in a situation where this corona-induced recession on the far right-hand side means that there's only about 4 stocks right now that are trading above their 200-day moving average. That's really the lowest, even from when we got back to the global recessions or when we had the financial crisis in a lot of these other situations. So not only has it been difficult to see the market fall this fast, it's been really broad-based. We also know at the same time that despite the fear mechanism in us and despite the index working and despite the markets working against us, we want to stay invested, because as this chart shows, looking at an 11-year time period, if you miss just the 10 best days of your portfolio, you lose 38% in value, and almost half if you miss just the 20 best days, basically just missing 1 day or 2 days a year. A great example of this was that the S&P 500 index, which was down 10% on Thursday, March 12th, was up 9.3% on Friday, March 13th, which was the next trading day. And that was after the biggest percentage loss since the Great Depression, until we set a new record yesterday, unfortunately. However, the commitment and to stay invested is extremely important. Another aspect of this is that when we work with clients to help build a financial plan, we use tools and resources that include these types of scenarios in that portfolio planning. So for those clients that we've talked to about this, about building a diversified portfolio, frequently we've mentioned what's called a Monte Carlo simulation. And in this case, it does not mean using a roulette wheel. In this case, it's doing 1,000 trials of a sample portfolio to see if it would be able to provide success for your long-term investments. As you can see in this situation, there are failures. Those are the red lines at the bottom of the squiggly line chart. And those reflect market and environments like this. But because this simulation looks at both the worst case scenarios and the best case scenarios, it's able to come up with a probability, in this case, of 850 successes out of 1,000 trials, which puts that plan right into that green zone, which you can see in the far right-hand side, which gives us a very good sense of having that success. So the key component here is to understand that as difficult as this environment is, it is included in our investment and financial models as we work with clients and investors. Another part about that emotional reactions to the market is to look at this sample. So this is looking at 3 investors. The person in the green line was the person who stayed invested the entire time. The person in the blue is what's called a waffler in this situation, and the person in red is called a reactor. This was statistics that came from Morningstar and from Schwab. So this is basically looking at back to 1980 from the investments. And the best way to think about this is the person in the green line stayed fully invested. Each of these people put the same amount of money in, and by staying fully invested, the person in green ended up on the top. The waffler has different points in time where they dropped out of the market and then got back in. You can see that in 1981. You can see that again in the early 1990s, and a few other situations along the lines. And really what that points to is the difficulty of having good timing. Then the person in red is basically the person who eventually ended up saying, you know what, the market is getting too tough. This is in 2008, 2009, they put all their portfolio into bonds and they were not able to participate in the upside. This provides some good perspective for how, regardless of how difficult it is from an emotional standpoint, the financial reasons why it is beneficial to stay invested, even in a situation like we're in right now with coronavirus. This chart looks at coronavirus compared to some of the other viral outbreaks that have taken place across the past, some of which have had a bigger impact on the markets and some which have not. The two best examples are SARS from 2003 and Zika from 2016. You can see in both of these situations, there was a time period where it went from peak to trough, which is effectively the bottom of the market, and then back to peak. In both of these cases, it was 3 to 4 months from that peak to trough time period. However, for those who stayed invested, in this case, that initial $1 million investment for SARS ended up at 1.3 million by the end of the year, or 1.1 million for Zika, versus those who sold out and went to bonds ended up missing out on that market recovery going forward. The other big question is what's happening to the economy. As I mentioned, we are probably and most likely in an economic recession right now. This is a chart that was done in mid to late February. probably is even a further drop down line here, but this was looking at global growth in the 2.5+% range. For US growth, we come into this year at about 2% as the estimate for what our quarterly growth would be. But as we can see here, a lot of corporations are taking a big hit. So the blue line is the corporate earnings estimates for 2020 that came out in early 2019. The orange line are what those estimates were before the coronavirus had really hit the market. And then the green lines are what those earnings estimates are as of March 11th, the most recent. And you can see that the expectations for the first quarter have gone down significantly. Second quarter is also low, and as we continue to grow the self-containment approaches, that will also continue to reduce that economic growth. But at the other hand, if you look back and look out just to the third and fourth quarter, you see we start to get back up to the types of growth rates that have been predicted previously. Another key component is what's been the response of the Federal Reserve. As a reflection of how quickly information is changing, when we put this slideshow together a couple days ago, it didn't even have time to record or reflect the most recent efforts by the Federal Reserve. Really what their role has been is to provide liquidity to the markets and stability to the banking system. They're less focused on what happens in the stock market and more focused on what happens with the economy. Their top two roles are really to be able to fight inflation and support full employment. So a lot of what they're doing right now is in an effort to help support those efforts going forward. Another key component is to understand health perspective. So at the bottom, I put this is also known as flattening the curve. So the chart at the top is basically a chart that was put out looking specifically at what happens with the coronavirus. And so if no protective measures are being taken place, we see a lot of cases and a lot of deaths happen in a short time period versus protective measures flattens out that curve, be able to help avoid the situation where the healthcare system is overrun and helps limit the number of deaths. The best example that we have from the past is from on the bottom chart from when the Spanish flu was taking place in America in 1918. In this case, both Philadelphia and St. Louis had seen the Spanish flu starting to come in the country. St. Louis had put a self-containment and a quarantine in place right away. Philadelphia, on the other hand, had a huge parade and a big celebration downtown in early October, which you can see by bringing a couple million people together ended up significantly increasing the amount of their death rate. So when people are talking about flattening the curve and having self-containment, it's really so that we can reduce and maintain and keep the number of active cases as low as possible. And that's really important because when we look at some of the estimates that are coming out about what the potential impact could be on both the economy and on the deaths rates, it's scary. So on the bottom, you see here the current global population is about 7.8 billion. Best case scenario is about 78,000 deaths. Worst case is about 1.5 million. As a reminder, right now we're at a little bit over 7,000 deaths on a global basis. I mean, it would still probably most likely, even in a best case scenario, get 10 times worse than it is right now. So that's the worst case scenario from a health standpoint. We can also see the impact from a GDP growth that in a base case, we'd see about negative 1.25 and about negative 2% going in the next couple of years versus a base case, we'd end up seeing some net base economic growth. So in summary for the slides, really what we're trying to do is provide that historical evidence to help understand what's happened in the past, what's happening right now, and use that to help us be able to understand what's going to happen next. So with that, I'm going to start to open it up to questions.
Okay, so thank you. So we've got a couple questions sent ahead of time, and then we've got a couple that have come in during our time together. First question is, do you feel the market has reached bottom yet? If not, would it make sense to park funds currently in equity into a money market until the market bottoms out and then move back? I'll throw that question out there, and maybe also the counter. We have had clients calling in saying, hey, is this the time to add more to my stock portfolio? And so I'll leave those 2 points of view with you, Jay.
Yeah, so very good question. So the first part is that we don't know when we're at a market bottom. In many respects, the stock market is a forward-looking reflection of what's taking place in the economy. So the stock market dropping as fast as it has been over the last couple of weeks is a reflection of what investors think is going to happen to the economy. So at some point here, we end up getting closer to the point where we feel like the stock market has fairly estimated the economic impact. And we don't know if that's now, if it's going to be in a month, if it was yesterday. We do know, though, if by not being able to participate in some of those best days, that what happens is that we end up missing out on a significant amount of that upside. For example, if we would have left the markets last week on Thursday after the worst day up until then, we would have ended up missing out on that 9+% day on Friday. After the horrible day yesterday, the markets are up 4 or 5% today. So from my perspective, when I'm talking to clients and when I'm talking to others, I would say now is that opportunity to stay fully invested as long as you have a cash flow in place. If you have extra cash that's out there, it could be a good time to put more money into the stock market, but we would recommend using a dollar cost averaging approach, where we put a portion in now, a portion in a month, and then that third component in 3 months. Basically just kind of averages it out if the market continues to fall, so you're not putting all your eggs in one basket.
So you're going to talk about a little bit with strategies like the rebalancing and tax loss harvesting during this time?
Yeah, so the small silver linings that we can find when the market is dropping like it is right now is, first and foremost, as Kathy mentioned, tax loss harvesting. So we take a look at investment positions where they are now versus their cost basis. If there's been enough of a loss from that prior component, we can sell that position and then buy a very similar position. What that means is the overall portfolio positioning stays very much the same, so you still have that opportunity to participate in the upside, but now you've harvested this taxable loss. Whether it's a few $1,000s or much more than that, then that taxable loss can be used to offset your income when it comes to tax time. At the same time, and in many respects right now, this is an opportunity to rebalance the portfolio. So what that means is we go back to this situation between elation and fear. So right now, stocks are reflecting fear, but bonds are reflecting elation. Stocks have now gotten below what our target allocation is, and so we end up selling bonds, which are high, to buy stocks, which are low. So if somebody, for example, was a 60-40 target investor, maybe right now they're closer to 45% stocks, we would sell 5% bonds and buy those stocks to bring them back up to that 60% target.
Thank you. We've had a couple questions with the Federal Reserve, so I'll put two into one. So the Federal Reserve has cut interest rates twice since the start of the coronavirus. Why did the stock market drop both times? And is the Federal Reserve truly an independent entity?
So I'm going to answer the second part of that question first. So the Federal Reserve is truly an independent entity. So as much as the White House may be talking about what they want the Federal Reserve to do, the Federal Reserve is making their decisions on their own. Also, they are not making it based on the stock market, which is a great reflection of the difference between the motivation from what's coming from the White House and what's coming from the Federal Reserve. As Kathy just mentioned, and as the questioner mentioned, the market dropped both times after the Fed reduced interest rates. But really, in particular, what they're really trying to do is they're trying to add liquidity to the marketplace. In particular, the component of adding that $1.5 trillion of liquidity before, in addition to $700 billion right now, and bringing interest rates down to zero helps protect the banking system. The other point is that they also reduced these bank reserve requirements, and all the major banks have now announced on their own that they are going to stop making buybacks, which is something they've done with a lot of their cash in the past. That means that banks have more cash available to lend at basically 0% to individuals and particularly small business owners. Those small business owners need to take out a 0% interest loan so that they continue to pay their mortgages and keep their business alive until we start to see the economy come back. So really the Federal Reserve has been less about what's going on in the market. It's been all about how do we help the small business owners and the other businesses owners out there right now and in the future.
And kind of a piggyback question that has come in about refinancing loans. Since the Fed has lowered interest rates, is this a good time for this? It certainly, mortgage rates remain really relatively low right now, and so it is a good time to look into refinancing. What we've seen just in the last week week and a couple days is that the mortgage industry is like flooded with new applicants wanting to refinance. And so the rates have ticked up a little bit. And as of yesterday, when we were checking, the rates were just a little bit higher, but we're still talking relatively low rates. So for us, we have like looked through our client base and identified opportunities, and we're watching for several clients. We can see those rates tick back down, but it is a good time to kind of keep that on your radar. Seeing rates anywhere for like 30-year fixed right around that 3.5%. So that's something that definitely should be considered for those who can do a refinance right now. Next question is, this situation seems completely different to anything we've experienced before. Both the supply and the demand sides of the economy are in shock until the virus clears. This may take 6 months. Can we really rely on past models since this appears to be a unique case?
In every situation, first of all, it's an excellent question. 2008 was unique when we had the banking crisis. 2001 was unique because of the dot-com crisis. 1987 was unique because of Black Monday. So they're all unique in their own ways, but they all have some similarities and some commonalities. So I would definitely agree. I think that if we could see our economy recover in 6 months, I think that would be a very good thing. It would mean the Fed was doing its job. It means that all of us on this line right now did our jobs from a self-containment perspective to limit the limit exposures and limit the spread of this virus. That being said, there are these models and there is historical information so that we can look back and see what's happened before. The most similar would be with the Spanish flu back in 1918 and 1919. That was not as much of a global economy then, so again, it's not necessarily the same, but generally the impact there from a death rate, which was much more significant. Over 70,000 Americans died between the 2 years with the flu, with the Spanish flu, and almost 2 million people died globally. So it did have a big impact on the economy. It was also a post-World War situation. So generally what we see is that we see the economic activity start to shift over time, and that's what we would expect in this situation as well.
Thank you. Another question, has electronic trading had an influence on recent market movements? If yes, how and why?
So just so everybody's aware, electronic trading is basically investors who have effectively programmed their computers to initiate buy or sell trades based on what's happening in the market. So they're not even pressing the buttons themselves. Those algorithms or those electronic trading have significantly contributed to the degree of the down days and the degree of the up days. Most of that is because the key components that those algorithms look at is momentum and volatility. Right now, those two have both been going generally in the same direction. So when we see these big market orders, and for example, like yesterday, for example, we ended up having to have one of the trading halts take place just within the first few minutes of trading. We're also seeing this at the end of the day when all of a sudden if a market was up, let's say 5,000 points, jumped up to 6,500 in the last half hour because of all these extra orders piling in at the end of the day or to the downside. This has really been a big part of what's taking place. It'll be something that will be looked at in the future. In the past, those electronic traders were felt like they could just be part of helping to maintain liquidity in the markets. But because so many of those trading models are similar, they end up creating extra volatility, particularly to the downside.
And what have my bond investments been doing so far this year?
Fixed income investments, depending on where they are up anywhere between 1% and 3%. Some of those investments, particularly if they're a little bit more risky, some of those are up even 10, 12, 15%. That's a reflection of what we're seeing as what they call a quote unquote risk off trade. So people are buying bonds. What happens is that when people buy bonds, it pushes the prices up, but it also pushes the yields or the interest rate down. So right now, if I was going to go out and buy a 2-year CD, I would be locking in a return of about 0.8%. We're also seeing money market funds starting to be forced to decrease the amount of interest that they can pay. It was at about 1.25% for the preferred money market at Charles Schwab that we use. But with the recent cut from the Federal Reserve interest rate, we could see that getting down to being about 0.5. part of the reason for that is then it helps, tries to give investors a reason to say, why would I want to keep money in the bank when I'm basically getting nothing for it? I may as well buy stocks.
And I would add too, so, clients will always have a portion in not only liquid investments, that is the cash ready to meet their living expenses, or bonds that will come due to replace future spending needs. So the bonds are the place that we can have many years to be able to cover us, to be able to tap into those bonds. For us in our strategy, we never take risk in our bonds. So we're always looking for top quality. Sometimes we will sacrifice the yield, meaning we won't get as much of the yield on those bonds, but we'll take that for quality. And so that's really holding up in our portfolios right now, which then, if you look at your individual holdings, you have many years that you can be able to take care of your living expenses. Going back to our charts, giving yourself time for the market to recover and not having to sell stocks at this point. So I think that's another piece to lay in that cash plan.
Mm-hmm.
Two kind of questions. Jay, do you want to, just this came in right, what defines a quality bond in our criteria?
Very good question. So in general, bonds are rated from AAA at the top down to AA, single A, then triple B, single, double B, B, and beyond. Basically, triple B and above are looked at as being high credit bonds. At the border of triple B and below, that's where they start to get into high yield / junk bonds. Our primary focus is on the AA and the AAA bonds. We feel that those are going to, by having the highest credit quality and having the best backing and support of the companies, the municipalities, the governments behind them, that's going to provide us the most security. Many of those triple B bonds that are out there that are viewed as being good credit, the component there is that if that company that's issued all these bonds, if their business is hurt and all of a sudden they have a harder and harder time of being able to pay for those bonds will go from triple B to single B, aka junk, in a very short period of time.
Thank you for that question. So there's kind of two questions. One we heard ahead of time and one that came in while we were chatting here, but it's really about like sectors. And so like the one person raised the question that kind of the travel, the airlines, the cruise lines, other travel related will be hit hardest. But there are other industries and other sectors, and just how do we look at that? This seems to be affecting many more sectors than we've experienced like in 9/11.
Right. So first of all, as Kathy mentioned, the travel industries, particularly airlines and cruise lines and others, now restaurants and bars, are the ones that are being hit the hardest right now. We would expect to see, and I know the government has already started to talk about providing a bailout for some of those organizations, which basically means a cash infusion so they can continue to stay in business. That's basically to keep those businesses alive, because once the economy recovers, we are going to need airlines again. People are going to want to start to take cruises. People are going to want to go out to dinner. So that's why some of that funding is out there, both from the government, as well as why the Federal Reserve has made it so that people can borrow money for so cheap. Other industries that have really been hit right now have actually been in the financial services side. So banks make a lot of money lending out money at high interest rates. So as interest rates have gone down, that's actually hurt banks a lot. Fortunately, it hasn't hurt the strength of those banks though, because of all the reserves, because of all of the regulations that changed in 2008, 2009, we're seeing banks are in a great position to have a lot of cash on hand. They're very stable. They're very well positioned so that they can lend out a lot of money and provide that role of really helping to support the businesses in their community, in their region, to help keep them in business for when things recover. Beyond that, energy has also been the other area that's gotten hit. That's somewhat independent of the coronavirus. That's really been tied in part to a little bit of an oil war between Saudi Arabia and Russia. But then the other part of that has just been decreased demand for oil. When people aren't driving their cars, when they aren't taking airplane trips, when some of the factories are shut down, that means less oil is being used. So the energy sector has been the other one that's been hit pretty hard.
Just one follow-up question on the bond. So the question was raised, so how can we basically trust the bond ratings? Haven't we had challenges with getting really true ratings, and were they overrated in terms of too favorable in the past?
Yeah, that was a very big issue that took place in 2008, 2009. From our perspective, the rating agencies have gotten better better. A big part that used to be there was a lot of the rating agencies were also the ones that were issuing the bonds. That's no longer the case now, because if you were issuing a bond, you would want to issue it at a AA or AAA if that would give you the most. But now that those rating agencies are independent, we feel like that perspective that they're providing, the ratings that they're providing, are more reliable. They're still not perfect, so we always take it with a grain of salt, which is another reason why we want to stay on that higher quality, because some of those AA's may be in reality single A's with a little bit independent, but at least they're not down in that junk bond region.
Okay, here's an interesting question. So one of our clients was watching Steve Mnuchin announce the purchase of commercial paper funding amid this whole coronavirus. So in layperson terms, what is this and how should it contribute to stabilization?
So we were just talking about bonds. So bonds are issued by big corporations, and they're issued in the hundreds of millions and the billions of dollars. Commercial papers are more small level loans. This is what a smaller corporation would do. They don't issue a big bond, but they issue what's called commercial paper. That's usually payable in a maximum of 270 days, which basically means in whatever that is, 9 months. Sounds about right for math off the top of my head. But by being shorter term and being tied specifically to that business, is a way for that business to get cash. It's usually at a very relatively low interest rate, but that's a financing way for smaller businesses that don't have the depth and the size to issue a big bond to be able to get a cash infusion through commercial paper. And those are issued then through their banking institution as the backer instead of a big bond rating agency.
Good. All right, so we're running out of questions here. So if anyone has one that they want to put in the Q&A, we have a few more minutes. Our plan was to go to 12:45.
Personally, I prefer the questions.
Okay, so feel free to use that Q&A screen. One other question, how is our stock market doing compared to Europe and Asia?
So right now, the best performing stock market in the world, ironically, is China. China has had the best performance because their government has put out billions of dollars to buy stocks directly, to support their banking institution, to help make sure that businesses don't go out of, that companies and industries don't go out of business. So China actually has the best performing stock market right now. But on real dollar terms, because the Chinese currency has gone down so far, it hasn't had good performance for a U.S. investor. Right now, the U.S. market is the best performing market in the world on a global basis. Europe is relatively strong behind there, and we are starting to see a little bit more strength in some of the emerging markets, in part because China makes up a big part of those emerging markets. It'll be very interesting over the next 6 months to see what happens to the mix of U.S. and non-U.S. as the Federal Reserve has cut interest rates. Part of the reason the U.S. dollar has been so strong over the last number of years is because all the foreign investors have wanted to invest in and buy U.S. bonds because we've been providing the best yields. Europe, for example, has had a lot of negative yielding bonds for the past couple of years. So with these lower interest rates, that may also help weaken the U.S. currency a little bit, which would actually be a good thing for both investors as well as for international and multinational businesses.
This is kind of like, it came up before, is just like, so if we've already set their allocation at 60% stocks, 40% bonds, or 70% stocks, 30% bonds, 50-50, whatever their current allocation would be, do you recommend sticking with that right now? Or how would you approach allocations knowing that they're moving off target?
Yeah, from our perspective, this chart right here is why we would say it's too early to make that decision, because if we are in a situation where we're going to see the global death count increase tenfold, right now is not the time period where we would want to be taking risk. Hopefully this is their best case scenario, is hopefully truly a worst case scenario, but this is again all based on what the scientists are saying. It really comes down to how we are addressing this, particularly the United States is one of the biggest countries that are out there in the world at both the national and a state and a municipal level. So if we can keep that contagion down, that will help. However, from an investment standpoint, I would want to wait before I would make that change from, let's say, 60-40 to 70-30. It would be that opportunity, as I mentioned before, if somebody has some cash on the sidelines, now would potentially be a good opportunity to bring that cash in as long as it's dollar cost averaging so that we can spread it out over the next few months.
And I would add, so this is kind of goes back to your planning situation. So when we run our long-term projections with you, we really try to think about like what's your ability to take risk and your willingness and your need. So we don't necessarily want anyone to take any more risk in their portfolio than they need to. And so this is why we have to kind of factor it in with, what are your other income sources? What's your spending, your regular spending, your out of the ordinary spending, what's coming up? What's that life expectancy? In our models, we often are planning way into the 90s. So it's really looking at that long-term plan, which Jay referenced earlier, which is run off of those 1,000 scenarios of both good and horrible markets like we have right now, to make sure we have the confidence that your plan is successful. So there's so many factors that go into us setting that allocation in the first place. But I would encourage, if any of you are just kind of wondering, and we're here. So this is the value of having an advisor. We are ready and waiting for your phone calls. I think that our clients overall have had a lot of training and don't like times like this, but this is also why you have an advisor in your life. And so please know that we're here for you to kind of talk through your specifics, any of your questions. I think that's all we've got for questions. There's a couple one-on-ones in my little Q&A box here that I will reach out to those questions, but thank you for being with us today. We really appreciate being a part of your lives, both the not so great times like this and the good times to come. We really appreciate all of you. We're here, give us a call, and I hope that maybe in the positives you find some comfort in being together with family and adopt new technology. Where for our parents, we're going to be doing more FaceTime calls with them, just kind of focusing on the value of family and being together during this time. So we're thinking of all of you. Bye for now.
Thank you so much.